The US market went up about 20% last year. But if you're a Singapore investor, your return may be closer to 14%. What's eating into your gains? A weaker US dollar. When you invest in US stocks, you're not just betting on companies, you're also taking on currency risks. Even if markets go up, a weaker dollar can quietly drag your returns down.
So as a Singapore investor, I convert my Sing dollars to US dollars to buy the S&P ETF, right? And let's say I held on to S&P for the next 2 years and I want to translate my gains back. Then S&P might appreciate in USD terms, but if I translate back to Singapore dollars, that's where you'll get the impact of the currency weakness.
This matters more if your portfolio is heavily in US markets, something increasingly common, especially with ETFs.
S&P ETFs are very popular. These are the group of investors that will have some exposure to the USD weakening.
So instead of reacting to the dollar, what should you focus on instead? First, focus on business quality. A weaker dollar doesn't hit all companies equally. Large US multinationals like Apple or Microsoft earn a big share of their revenue overseas.
So actually about 40 to 50% of the revenue of these large American multinationals are international.
So when the US dollar weakens, those overseas earnings can actually become more valuable. And strong companies have something else: pricing power.
Going back to the example of Apple, if the US dollar remained weak and it was affecting Apple's profit margins, well, Apple makes a very successful and high demand product. They will just raise the price of their iPhone in US dollars to make up for that depreciation, to cover their costs, to maintain their profit margins. They can do that because they have pricing powers.
Next, understand where currency risk matters most. For stocks, currency moves are usually a smaller factor. But for bonds, it's different. Bond returns are fixed. So if the US dollar weakens, it can wipe out the gains you thought you were getting.
So most Singapore investors, they might see the headlines of USD weakening and they might consider Singapore corporates. However, Singapore corporates today typically gives anywhere between 3 to 3.5% Singapore yield. So if I were to invest in US investment-grade corporates, so essentially lending to the Microsofts and Amazons, they typically give 5 to 5.5% USD yield. In a fixed income, you get agreed fixed coupons and you get back your principal at the end. So if I'm an investor lending to a US corporate, I've already fixed my yield. And the problem with that is, assuming all other factors are constant, if I translate those fixed yield back to a foreign currency, then it will be subject to currency weakening.
There's a way to protect yourself. It's called hedging. It reduces the impact of currency swings. But it's not free. You have to pay for that protection.
Now, the challenge is, if I were to fully hedge the currency risk today, the cost of hedging typically is 1.5 to 2%. So shave that off away from your 5 to 5.5, you pretty much match the local corporate bond yields.
Third, check your concentration risk. A lot of investors today are heavily concentrated in the US. Diversifying part of a portfolio could help reduce that exposure.
You've never had foreign ownership of the US as high as it is now. You've never had people owning equities in the US as high as they are now. So you've got this massive concentration risk that if anything was to happen, in the US in particular, that could quickly unravel, and then you're going to be trapped with everyone else.
A weaker US dollar can actually benefit other markets, especially emerging economies. That's why some investors are looking to diversify, not to make a big switch, but gradually rebalance. But before making any move, ask yourself a simple question. Why are you holding US dollar assets in the first place?
For example, they plan to send their kids to the US to study, or they wish to buy a house there or something like that, then it makes sense to keep these assets in US dollars, because no matter what happens. Your goal is to spend this US dollars on a certain objective.
But if your spending is in Singapore dollars, currency risk becomes much more important. Finally, if you were already planning to invest, a weaker dollar could actually be an opportunity. Your entry point could now be cheaper.
If you have investments that you want to make in US dollars, now is a good time to buy US dollars to fund those investments.
So the takeaway isn't to avoid the US. It's to understand what you're exposed to.
The main message is we shouldn't overreact to recent headlines. Today it will be the attack on Iran. Tomorrow it could be another geopolitical war of some different form. And maybe the following, it could be some event that we might not predict. And ultimately, we shouldn't have the mindset of trying to make binary bets and trying to position after such events. We want to build a portfolio that is a lot more diversified, that can withstand such impacts, rather than trying to overly time the market.
Because currency moves come and go, but a well-constructed portfolio is built to last.